Great question. And yes, there are some pretty significant differences between mortgage insurance through a bank and a term life policy, which is what you'd get through a financial advisor. Three main differences. So number one, with the mortgage insurance that you get through the bank, you're only covered for the amount of the mortgage, which goes down over time. So the first year, you're covered for $250,000, let's say. And then over the course of that first year, you pay off $10,000 of that mortgage. Well, now you're only covered for $240,000. And then the next year, $230,000, and then $215,000, and then $200,000, and so on and so forth. Whereas if you get a term life policy, if you get $250,000 of coverage, that is always going to be $250,000 of coverage. It doesn't matter what you paid off and where you put your money. That stays consistent. Number two, with mortgage insurance through a bank, if you pass away, your mortgage disappears, right? Which means, in essence, the bank is going to get that money. That's how they pay off the mortgage. Whereas if you get a term life policy, your beneficiary is going to get the money. So if you pass away, yeah, they can use it to pay off the mortgage if they want, or they can choose to pay off some kind of high interest credit that you may have, line of credit, credit cards, whatever. Or they can just use it as replacement income because the kids still have to go to dance and hockey, and they still have to pay for an education, and you still have to pay hydro, all that kind of stuff. Number three, and this one is a little more subtle, but equally as important as the other issues. Typically, mortgage insurance through a bank is what we call underwritten at time of claim, which means when you go to make the claim, i.e. a loved one has passed away, that's when all of your information gets sent to the medical underwriting team. And they determine whether or not you can qualify for the insurance, even though you've already been paying into it for X amount of years. And some people have been burned by that. Now, if you get a term policy through a financial advisor, it's what we call underwritten at time of application, which means when you're going through the application process, that's when it goes to the medical underwriting team to determine whether or not you qualify for the insurance. So if the insurance is placed in force, you know you qualify for it. You don't have to guess later on. So no, they're not the same. Three pretty significant differences.